What if I told you a stock trading for less than $1 just wiped out a $50 million obligation in a single afternoon, and the market rewarded it with a 38% single-day gain? This isn't a story about hype or a random Reddit thread. This is a story about a wireless and fintech company that's been quietly bleeding cash for over a year, that just made one contractual move that fundamentally changed its cost structure overnight. I've spent the last few days digging through the filings, the earnings history, and the wholesale agreement itself, and I want to walk you through exactly what happened, why it matters, and where the real risk still sits. Stick around, because by the end of this video you'll understand this setup better than most people trading it right now. Let's start with what this company actually does, because that context matters more than people realize. This is a wireless and financial technology company built around one specific mission: connecting subprime and underserved consumers to essential mobile and financial services. Think about the customer base most telecom companies ignore: people without perfect credit, people who need prepaid plans because a traditional postpaid contract isn't realistic for their situation, people who rely on convenience stores, not big box retailers, for their day-to-day financial transactions. This company built its entire business model around serving exactly that population, operating through two main segments. One is a mobile virtual network operator business, meaning they don't own cell towers. They lease network capacity from a major carrier and resell prepaid wireless plans under their own branding. The other is a platform services business, providing point-of-sale technology, ACH banking relationships, and transaction processing tools to thousands of small retail locations across the country. On paper, that's a smart niche. Underserved consumers are a massive market, and prepaid wireless combined with fintech services at the retail counter is a real, defensible business model if it's executed well. But here's where the story gets complicated, and I want to be honest with you about this before we get to the good news, because you need the full picture to understand why this rally actually matters. This stock has had a brutal 12 months. Over the past year, shares are down roughly 88%. That is not a typo. 88%. The company's market cap shrank to somewhere in the single-digit millions, which for a company doing real revenue is an extraordinarily low valuation, and usually a sign that the market has lost almost all confidence in the business. Analyst price targets got slashed too. Earlier this year, one firm cut their target from $9.75 all the way down to $5. When you see a price target cut of that magnitude, it tells you Wall Street's own analysts were revising their expectations sharply downward, not because of one bad headline, but because of a pattern of disappointing results. And the most recent quarter didn't help. When the company reported first quarter 2026 earnings, they posted a loss of 51 cents per share, against a forecast that called for a penny of positive earnings. That's an enormous miss, not a small one. Revenue came in around $16 million, which sounds fine until you realize the market had been modeling something closer to double that number for the quarter. Gross margins over the trailing 12 months were sitting in negative territory, meaning at points, this company was literally losing money on every unit of revenue before you even get to overhead and operating expenses. This is the backdrop you need to understand, because it explains why the stock had fallen so far. And it's also exactly why what happened at the start of this month is such a big deal. On July 1st, this company announced an amended wholesale agreement with one of its Tier 1 wireless network providers. Now, wholesale agreements are the unglamorous, behind-the-scenes contracts that determine how much a company like this pays to lease network capacity and access from the major carriers. They rarely make headlines, but this one did because of what it removed. The original agreement had included a minimum spend commitment of $50 million over a 3-year term. That means regardless of how many customers actually signed up, regardless of how the business performed, this company was contractually on the hook to spend $50 million with its wireless partner over that period. That kind of fixed commitment is a massive liability for a company this size, because it doesn't scale with performance. If subscriber growth slows down, you're still obligated to hit that number, which either forces you to overspend relative to actual demand or triggers penalty exposure. The amended agreement eliminated that entire $50 million minimum spend commitment. Just gone. On top of that, The wireless partner agreed to waive approximately $10.3 million in previously billed minimum commitment charges that were already sitting on the books. That waiver alone reduces the company's accounts payable and is expected to generate an estimated gain of around $8.5 million in the second quarter. For a company with a market cap in the low double-digit millions before this news, an $8.5 million one-time gain, plus the removal of a $50 million future liability, is not a small adjustment. It's a fundamental change to the balance sheet. But here's the part that matters even more for the long-term story than the one-time accounting gain. The new agreement doesn't just remove the old liability. It changes the entire pricing model going forward. Instead of a fixed, front-loaded minimum spend commitment, the company now operates under a usage-based cost structure. That means their wholesale wireless costs scale with actual subscriber activity instead of being locked into a rigid dollar figure regardless of demand. For a company trying to grow its subscriber base profitably, that shift from fixed commitment to usage-based pricing is the difference between a business model that punishes you for growing slowly and one that lets your costs breathe with your actual performance. Management framed this directly as a way to lower customer acquisition costs and improve the unit economics of every new wireless subscriber they bring on. In plain terms, it should now cost less per customer to grow the wireless side of the business than it did a month ago. Now let's talk about what happened to the stock, because this is where the real trading story begins. On the day this news hit, shares moved from around 41 cents to approximately 58 cents, a single-day gain of roughly 38%. For context, at these price levels, moves like that happen fast, and they happen on relatively modest dollar amounts of actual capital, which is both the opportunity and the risk with a stock like this. A 38% move on a 50-cent stock takes far less buying pressure than the same percentage move on a $50 stock, which means these moves can reverse just as quickly as they appear if the buying interest dries up. Let's zoom out to the fundamentals one more time, because I want you to have the complete picture, not just the exciting headline. Subscriber growth has actually been a genuine bright spot underneath all the noise. Total wireless subscriber lines surpassed 200,000 across the company's prepaid brands, and revenue in the most recent quarter, even with the earnings miss, was still up 51% year-over-year, driven specifically by point of sale and prepaid services growth of 71%. That's real, measurable top line growth in the core business lines. This wholesale amendment is designed to make more profitable. Management has also been cutting costs elsewhere, with general and administrative expenses down approximately 25% as part of a broader cost discipline initiative that started last year. So you have a company that's growing its subscriber base and its revenue, cutting its overhead, and now removing one of its biggest structural cost liabilities, all at the same time. That combination is exactly the kind of turnaround setup that penny stock traders look for. Because if it works, the operating leverage on the way up can be dramatic for a company this small. There's also a second storyline worth knowing about here, because it shows management is trying multiple angles to diversify revenue beyond core wireless. Earlier this year, the company signed a master services agreement to build a real-time AI decisioning engine aimed at driving higher revenue per subscriber, and separately launched a pilot program integrating a mobile wallet product across its retail distribution network, with a structure that includes activation bounties and a long-term revenue share component. Neither of these is the main event here. The wholesale amendment is, but they show a management team actively trying to build new monetization layers on top of their existing subprime customer base rather than just riding out the wireless business alone. Now for the risk side, and I want to spend real time here because I don't think you should walk into this without understanding exactly what could go wrong. This is still a company that lost 51 cents per share against a forecast of a positive penny just one quarter ago. That is a significant miss, and it tells you that even with a favorable contract amendment, execution risk here is very real. The stock, even after this 38% pop, remained down roughly 88% over the trailing 12 months, which means the broader trend has been overwhelmingly negative. And one positive news event does not automatically reverse a year of value destruction. Analyst price targets were cut sharply earlier this year, and while a $5 target might sound exciting relative to a 50-cent stock price, you have to remember that target itself was already a steep reduction from where it used to sit. And analyst targets on names this small and this volatile should be treated as rough guideposts, not promises. The market cap here is extremely small, in the single-digit millions of dollars, which means liquidity can be thin, spreads can be wide, and both upside and downside moves can happen violently on relatively little trading volume. This is about as high risk, high volatility as setup as you'll find in the penny stock world, and it is absolutely not a substitute for money you need for anything else in your life. So here's how I'm thinking about this one. You have a company with a genuinely rough recent earnings history and a stock that's down almost 90% over the past year, which is the bear case in full force. But you also have real subscriber growth, real revenue growth in the core business lines, real cost discipline showing up in the numbers, and now a contractual change that removes a $50 million liability while shifting the entire wholesale cost structure to something that scales with actual performance, instead of punishing the company for growing at its own pace. That's not a meme pump built on a rumor. That's a legitimate structural change to how this business operates financially. And the market's initial reaction, a 38% single-day move, tells you traders recognize that difference immediately. Whether this turns into a multi-week trend or fades back down depends entirely on what happens next. Does subscriber growth continue at that 71% pace in prepaid and point-of-sale services? Does the usage-based pricing model actually translate into the margin improvement management is promising? Does the next earnings reports show the company finally closing the gap between forecasted and actual results instead of missing again? Those are the questions that will determine whether this becomes a real turnaround story or just a one-week bounce in a stock that's still down 88% from a year ago. I'll be watching the next earnings report closely. And if you want to see how this plays out, that's exactly the kind of follow-up we do here. So there it is, the stock behind this 38% single-day move, on the back of a $50 million liability, elimination, and a full restructuring of its wholesale wireless economics, is SurgePace, ticker SURG, trading on the NASDAQ. If you found this breakdown useful, hit subscribe, because we're going to be tracking exactly what this company does with its next earnings report to see if this turnaround actually sticks.